Hi everyone and welcome to the Market Compass. Hard to believe, but we're now closer to 2026 than we are to 2024. As we turn the page to the second half of the year, we'll take a look back at how markets and the economy performed during a volatile first half, and more importantly, what we see ahead. From market resilience to inflation trends and sector opportunities, we'll cover the key themes we see shaping the rest of 2025. The first half of the year was a roller coaster. The S&P 500 dropped almost 20% early in the year, only to rebound to new all-time highs by late June, marking the fastest recovery from a 15% plus decline in 75 years. Despite trade tensions and geopolitical shocks, markets proved remarkably resilient, supported by strong corporate earnings and solid economic fundamentals. Some of the key highlights included the largest spike in volatility since the 2020 pandemic and the 2008 financial crisis, the best first-half bond performance in 5 years, and the strongest outperformance of international equities versus US stocks since 1993. That was helped by the weakest first-half performance for the US dollar in 50 years. These notable moves underscore the importance of having a long-term plan and sticking to it rather than reacting to headlines. Looking ahead, the US economy is expected to slow but avoid a recession. Higher tariffs and trade disruptions will likely weigh on growth, with effects possibly showing up in the data in the coming months. However, the recent passage of the new tax bill has brought clarity to fiscal policy. We expect modest fiscal stimulus next year, with tax cuts, increased business investment, and deregulation supporting a pickup in activity. We expect the growth path may dip before it rises again heading into 2026, with unemployment remaining low by historical standards. Inflation tells a slightly different story. We expect it to tick higher in the second half as pre-tariff inventories are depleted and companies begin passing on higher costs. That said, this bump may be temporary, with services inflation staying relatively tame. The bottom line is that while stagflation concerns may rise, the economy appears well positioned to weather volatility as some of the headwinds ease in 2026. With unemployment low and inflation risks still present, the Fed is likely to remain in wait-and-see mode. But with rates already elevated, there is room to cut if inflation trends lower in 2026. We expect 1 to 2 rate cuts in the second half of the year, with a couple of more next year as the Fed gradually moves towards neutral. We continue to expect 10-year Treasury yields to stay in the 4 to 4.5% range. While yields may temporarily move outside of this range, we see guardrails on both sides. Slower growth and Fed easing could cap the upside, while deficit concerns and inflation uncertainty could limit the downside. With the S&P 500 at record highs, we expect stocks to take a breather, but we remain cautiously optimistic. Corporate earnings remain the key driver, and forward estimates are hitting new highs after a dip in April. Companies tied to artificial intelligence continue to post earnings that outpace the rest of the index. On the other hand, mid-cap and value-oriented stocks may benefit later in the year as rates decline and growth reaccelerates in 2026. Balancing growth and value styles can help portfolios navigate the evolving landscape. Diversification will likely remain the name of the game this year amid the patient Fed and trade disruptions. We recommend overweighing US large and mid-cap equities and see opportunities in financials, healthcare, and consumer discretionary. While we favor a slight domestic tilt, international markets remain attractive, especially for under-allocated investors. And for those seeking income, we think 7 to 10-year higher quality bonds that currently yield around 5% offer compelling value relative to recent history. To sum it up, while uncertainty hasn't disappeared, we're seeing more clarity on the path forward. Markets have shown resilience, the economy is holding up, and opportunities remain across asset classes. We view pullbacks as buying opportunities, especially as rate cuts and fiscal support kick in next year. As always, staying diversified and focused on long-term goals can help you navigate what's ahead. Thanks for watching, and we'll see you next time.